Welcome to the Deep Dive. We're going to break down the essential insights from today's financial calls. Today, we're focusing on the recent Triumph earnings call. Our goal is to give you the key takeaways without you having to sit through the whole thing. So, what's the big picture?
Well, the headline earnings, they definitely saw some headwinds, mostly from, the tough transportation market.
Okay, not unexpected, maybe.
Right. But if you actually look a little closer, almost every metric they reported for their transportation businesses actually improved.
Really? Like which ones?
Especially the payments segment, that looked quite strong. And credit quality showed improvement, too.
Interesting. So beneath the surface, a better story.
Exactly. The real question now, and what we'll dig into, is can they actually deliver profitable revenue growth for the rest of the year and, beyond, given the market?
And they think they can.
They seem pretty confident. They're pointing to investments they've already made.
All right, let's unpack that. How are they planning to grow revenue in this environment? Sounds like multiple angles.
Absolutely. A big piece is monetizing their existing payment client relationships better. For instance, that C.H. Robinson relationship, they expect that to really kick in during the back half of the year. So you should expect to see their payment KPIs, key performance indicators moving up because of deals like that one and others.
So less about just chasing new logos, more about getting value from who they already have.
That's a major part of it. And they're also really focused on showing their legacy payment clients just how much better their technology suite is now.
Right, the upgraded platform.
Exactly. They see a big opportunity there for organic growth just within that existing customer base. And importantly, new customers are coming on at the current higher pricing.
Makes sense. What about the factoring side? That's usually a decent contributor for them.
Yeah, and they said it's back on the offensive. Apparently, the uncertainty around tariffs is actually creating some opportunities.
How so?
Well, some large trucking companies are coming back to factoring. They might be running into issues with covenants on their commercial bank loans, in this tougher climate. So factoring looks attractive again.
Interesting dynamic. And what about newer products like green screens or load pay? Are they starting to move the needle?
They are starting to contribute, yes. Load pay's impact is expected to be more weighted towards the second half of the year, though.
Okay.
And it's worth noting the second quarter's revenue might look a bit noisy, partly because they expect the green screens acquisition to close then, maybe other factors too.
So the second half gives a clearer picture of the revenue trend.
That's the indication, yes. Probably a cleaner run rate to look at then.
Got it. They mentioned transportation businesses around, $206 million now? What's the growth target look like?
They're aiming for material revenue growth there. Significant growth, really, to justify the continued investment. Payments and factoring, those are expected to be the biggest contributors in gross dollar terms. The intelligence revenue, that's more of a ramp up into next year.
Okay, let's zoom in on payments monetization. You mentioned it was strong. I saw payment fees were up 12, 13%, but invoice volume only rose 3-4%. What's the story there?
Yeah, that's a really key point. It signals they're getting much better at monetizing that payments business, generating more revenue per transaction, essentially.
Now,
Well, their payment charges are actually separate from just processing a standard invoice or, a network transaction. So their fee income can grow even if the basic volume doesn't jump as much.
so they're decoupling revenue growth from just counting transactions.
Exactly. It points to better pricing power, maybe moving towards higher value services. They feel there's a real opportunity to charge fairly for the value they deliver across all payment services, not just the network stuff.
Explain that distinction a bit more, network versus non-network.
Sure. So network transactions are kind of a subset. Brokers, they pay for both the audit service and the payment service, whether it's technically a network transaction or not. The payees, who are often factoring companies, they get billed specifically for those network transactions.
Okay.
So the point is, Triumph can grow its revenue, especially that high-value fee income, outside of just pure network volume increases.
Got it. That makes sense. Now, what about the next-gen audit platform migration? How's that going?
Pretty well, it seems. They said they've already realized about $4 million in annualized benefit from upgrading older contracts to next-gen and cross-selling payments alongside it.
Only $4 million so far.
Well, here's the thing. They estimate they've captured less than half of the total opportunity from that migration.
Oh, wow. Right.
Yeah, so they expect the rest of that benefit to come through over the next several quarters. Think of it like moving clients from basic cable to the full premium package, right? They can offer more, charge more.
And pricing for new clients versus migrating old ones.
New clients are coming in at the standard Current quoted prices for both audit and payments. No discounts there.
And the legacy clients. How do you convince them to pay more?
Their strategy is to really highlight the data and the value they get now. Better dashboards showing concrete savings, work they've offloaded, better fraud protection. The message is, the product you have now is way more advanced than what you originally paid for years ago.
Sounds like a dedicated push.
Yeah, they have a team specifically working on repricing those legacy clients. They said they're seeing positive results already and are, refining the approach.
Okay. Another thing mentioned was factoring as a service, FAS. Sounds very early stage.
Extremely early. They only have one customer right now.
Just one.
Yeah, they're being deliberate. They called it a high-touch product, so they want to perfect it before they try to scale it broadly. Plan is to add maybe one more FAFAS client this year, then look for more growth in 2026 as they figure out how to onboard them more easily.
But the traditional factoring business is still the main engine there.
Oh, yeah. It generated $144 million last quarter, and they even called that a low quarter for the segment, so still very significant.
And the vision for factoring overall, including FACE.
The expectation is for the whole factoring segment, including FACE eventually, to at least double as part of their bigger goal of getting to $1 billion in total revenue. FACE revenue gets rolled into that segment.
Right. Now, Green Screen's the acquisition. What did they say about that? Obviously pending, so maybe limited details.
Exactly. Limited financial details because it's still private, waiting on regulatory approval. They expect it to close in Q2 and promised more info on the next call after it's done.
But they must have talked about the rationale, the opportunity.
Definitely. They stressed the size of the market opportunity, said the industry spends over $600 million a year on the kinds of products that fit into their intelligence plans.
$600 million. Wow.
Yeah. So huge demand, they believe, for better intelligence tools for brokers.
And they were pretty direct about why this acquisition makes more sense than, say, buying back stock, right?
Yeah, it's very clear. Their view is that leveraging their existing data, all that granular stuff from factoring and payments to build out these intelligence offerings, will create much more long-term shareholder value than buybacks would right now.
A big bet on data and intelligence then.
A very strategic bet, yes.
Okay, finally, let's talk credit quality.
They sounded fairly optimistic despite, well, everything going on economically.
They did. The improved credit metrics they showed in Q1, that was apparently the result of work they'd already done, addressing stress in their equipment finance portfolio from the freight recession.
So proactive measures paying off.
Seems like it. They said they're maybe 40% of the way through working out those stress credits and feel they have enough reserves set aside. So yeah, optimism for Q2 and Q3, but that assumes, a reasonably stable environment.
But they acknowledged risks remain, didn't they? Tariffs, potential recession. Absolutely. They know they need to keep a close eye on the portfolio, especially with potential tariff impacts or if the economy really turns down. They also pointed out the revenue volatility risk from that 36-day repricing cycle on many assets. But the main focus, they stressed, is still growing revenue overall.
Do they seem to have a good handle on the problem assets?
They conveyed that, yes. Said management has a detailed view of the classified assets, specific plans for resolving them, and an interesting point they made. These equipment finance loans amortize pretty quickly. Plus, most of the current loans were actually originated during the tough freight market of the last few years, not back in the 2020-21 boom, so they're already seasoned in a challenging environment.
Okay, so the hope is credit won't be a big drag going forward.
That's the expectation for the back half of the year. They want the focus squarely on revenue growth and getting those margins up.
All right, so pulling it all together, what are the key things for someone following Triumph to keep in mind?
Okay, several things. First, the fact they improved key metrics in transport despite the freight headwinds. That suggests some underlying strength. Potential for growth if the market turns, or just from their own initiatives gaining traction.
Right, resilience.
Second, the focus on monetizing existing payment clients better, plus getting new ones at higher prices. That points to potential margin expansion in a really key area.
Better profitability.
Third, that Green Screen's acquisition. It's a clear signal they're serious about capturing that big intelligence market opportunity. Could be a whole new growth engine down the line.
The data play.
And finally, the improving credit quality, even with all the uncertainty. It suggests they're managing risk effectively in their lending side.
Okay, good summary. Now, for our, this is not financial advice segment. Let's toss around a slightly out there trade idea based on this. Triumph's big bet on data and intelligence is interesting.
Yeah, it is. Okay, so building on that, here's a thought. Again, purely hypothetical, not advice. Maybe you consider a long position in companies that are specialists in data analytics and AI for the transport sector, the picks and shovels for what Triumph is trying to build, right?
Samplers.
Exactly. And maybe, just maybe, you pair that with a short position in some of the legacy traditional transport brokerage firms, the ones that seem slow to adopt this kind of advanced data analytics stuff.
Interesting contrast.
The idea, the thesis would be, if Triumph's move with green screens really signals where the industry is headed, then the analytics tool providers could see a boost. And the older school brokers who don't adapt, they might face more pressure, maybe lose share as insights become more critical.
A disruption play.
Potentially. But again, it's just a hypothetical scenario for you to think about. Definitely not financial advice.
Understood. Well, that wraps up our deep dive into the Triumph earnings call. We hit the results, the strategies, management's outlook. Hopefully this breakdown gave you some valuable insights into what's driving the company. Think about that shift towards monetizing existing value and what green screens could mean for the competitive playing field. Join us next time on The Deep Dive for another focused look at the markets.